It's panic at the top. I'm your host, Steve Van Metre. Thanks for joining me today. In our show today, top Biden officials are in a secret meeting right now that will determine the fate of the Democratic Party. And everyone wants to know if President Biden will continue to run for a second term or if he'll step aside and let someone else take the reins. And while everyone right now is focused on the political angle, they're missing out on something much bigger, which could cause the incumbent president to bow out of the race, and that's the U.S. economy. And we just got new evidence today that says we're on the cusp of a very large and deep recession. Plus, we have a sponsor for today's show. We'd like to welcome Black Box Stocks back to the show. You can find them on the NASDAQ under symbol BLBX, and the reason you do is because the stock now has pulled back into a supply zone for the fifth time in the last 6 months, and on average, the stock rallies 20% out of the supply zone. This is something you don't want to miss out on. I'll show you the chart setup and all the latest information on the company. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg. We'll start the show out with a political angle as Biden allies dismiss calls to quit and forensic weekend blitz. And of course, they don't want anyone to know that there's a possibility the president would step aside and let someone else run for office. The question then becomes, what is the fate of the Democratic Party? Which is more important? Is it that President Biden tries for a second term or perhaps puts someone up to run that has much better odds, particularly with where the economy is going? An aide spent the weekend publicly dismissing suggestions that Biden will reconsider his candidacy or take dramatic steps to overhaul his operation. They angrily denounced the suggestion Biden and his family might entertain a discussion of leaving the race as they travel to Camp David for a private getaway, and no doubt that is going to be the top topic of their getaway right now. That's why we're there, to get any information we can, because a post-debate poll by CBS News found that just 28% of registered voters believe Biden should be running for president, including only 54% of the president's own party. Some 72% said Biden didn't have the mental and cognitive health to serve as president, and this puts him in a dangerous situation, because what is better for the party, either to have him run or maybe put someone else in that people are more likely to stand behind? It's unanimous in the donor class, as every single person I've encountered, including a number of billionaires, some of the biggest donors in the country I've spoken with, and they've completely aligned with me that Biden needs to go. This from Tilson, a former hedge fund manager. So there's a complete disconnect between the campaign and the donor class, suggesting, of course, if the big money starts to pull back, well, the president may have no choice but to step aside. But some of this pulled back deep into a supply zone is creating opportunity for you. Is the stock of our sponsor of today's show, Black Box Stocks, on the NASDAQ under symbol BLBX. And here we're looking at a 6 months chart. And down here between these two purple lines is what's called a supply zone, where buyers are at. And you can see it's pulled down here 1, 2, 3, 4, and now for a fifth time. And on average, it rallies from about $2.50 up to $3, or a 20% return. Put this one on your hot list and stay tuned for more information. As Biden's team also had a few alternatives, as long as the president wants to remain in the race, necessitating a posture in which staffers must stake their credibility and legacies to not further diminish a wounded candidate, because this has very high stakes. If he doesn't win, well, that means a lot of people are probably going to be on their way out in the party, and this is forcing Biden from the ticket is virtually impossible under Democratic Party rules, and the president and his allies have decades of connections throughout Washington, including personal friendships with top lawmakers. So my question to you is, does President Biden stay in the race or does he step aside? And if he does, who do you think they're going to nominate in his place? Weigh in the comments below. I'd love to hear from you. And while the party is still virtually circling the wagons, they clearly want Biden out and are giving him space to determine his next steps. Hence, of course, the trip to Camp David. They believe only the president, in consultation with his family, can decide whether to move forward or to end his campaign early, and that he won't respond well to being pushed. Well, nobody likes that. The only person who has ultimate influence with him is the First Lady. If she decides there should be a change of course, well, there will be. And a source familiar with the situation, scrambled to let them know that the Camp David gathering was not a formal family meeting. Now, of course, if you believe that, well, perhaps we have something else to talk about. Any discussion about the campaign is expected to be informal or an afterthought. There's no doubt in my mind that is the topic of this getaway, is does he stay in the race? Because things with the U.S. economy are starting to change in a rather quick way, and this is a dangerous game for the president, because what we note is if we're in a recession, by the time there's election, the odds of an incumbent president getting a second term fall somewhere near zero. But to show you what's going on with the U.S. economy, I want you to see where we're headed. And to that, let's start with China. We have their China factory activity shrinks again in a warning to the economy, and what starts in China eventually gets to the U.S. as the official manufacturing purchasing manager index was at 49.5. That was the same reading as May and in line with economists' predictions in a recent survey. Any number above 50 points denotes an expansion, suggesting, as we've been seeing all around the world, the manufacturing sectors continue to slow down and contract. And when that happens, well, it means the economy is headed for mass unemployment. And over the last couple of weeks, we continue to see a slight uptick in continued unemployment claims, and at some point, as we've noted, that will lead to a large increase in initial claims. When that happens, it's game over, and perhaps a bigger reason why President Biden may choose to step aside. A sub-index of new orders at factories inched lower to 49.5 as demand weakened. This is actually fairly interesting. Despite a weaker yuan, demand is going down. So you would think production would shift over to China. It's not. It just goes to show that how weak the global economy is, that not even a weaker yuan is creating demand. A gauge measuring new export orders was unchanged at 48.3. As you can see, contraction across the board. Meanwhile, the non-manufacturing measure activity or services sector for construction and services fell to 50.5. That compares with a forecast of 51 and a May reading of 51.1, suggesting as we've made the case that where the manufacturing sector goes, the services sector eventually falls with a lag. So what we're seeing is China's manufacturing sector continue to stay in a contraction, and that's likely to accelerate, followed by its services sector. And that's what's causing interest rates there to go down, as China's 10-year yield falls to record as economic gloom deepens. And keep in mind, long-term interest rates, regardless of where we're at, are a function of growth and inflation expectations. So even though what we're hearing from the PBOC and out of Beijing is they don't want to see rates go down even further, because that will send money over here to the U.S. where rates remain artificially high, it's just a sign that their economy is continuing to get worse. And the bond rally reflects lingering concerns over weak domestic demand and hopes that PBOC may need to cut policy rates in the third quarter to bolster growth. That's exactly what the bond market is trying to tell the PBOC. Demand for bonds will be mainly supported by banks and wealth management products as they receive continued fund inflows from a flight out of deposits. What's more important here is not where funds are flowing, but why banks are choosing to buy bonds. It's very simple. Rather than lend money into a weakening economy, which of course we understand, according to recent Fed stress tests, that they believe that U.S. banks will continue to lend into a downturn. And we know that's not likely, but what we're seeing here is banks would rather take on the safety and security of government bonds than lend money, and under the knowledge that they may not get it back. And what we're seeing in China is exactly what we're eventually going to see in the U.S. and may be part of the reason why, when we do have the eventual recession here, it's going to be very dangerous. As we look at commercial industrial lending, this is the weekly data shown on a year-over-year rate of change in blue against two-year Treasury yields shown in red. And when you see decelerations in credit in a debt-based economy, it starts to tell you that interest rates are just too high. And if you want to stimulate people to borrow, it means rates need to go down, which is why you see different periods where the blue line is slowing down and even in contraction underneath the horizontal black line, and rates come down. But right now the market is completely fixated and believes that rates here in the US need to stay elevated. And I want to point out the last time this happened, we faced a double dip recession in the 1980s. So as investors bet against the bond market, they're setting themselves up for even bigger failure here coming forward. But at some point, rates in the US indeed will come down. But for the moment, there seems to be even a Trump effect. But let's talk about the US economy now and why where China is where we're headed as US factory activity shrinks for the third month as prices moderate, which is interesting. Even though prices moderated, we see sellers in the bond market. I'll tell you what, of course, the market says is driving that. As the Institute for Supply Management's manufacturing gauge was little change at 48.5 compared with 48.7 a month earlier, indicating further contraction in U.S. manufacturers. Prices paid for materials fell 4.9 points. That means disinflation, the most since May of 2023. And at 52.1, the index shows the slowest growth in cost this year. So it says they're rising, but not nearly as much as, of course, because demand is coming down in a big way, not just in China, but all over the world. And while the overall manufacturing gauge still shows shrinking activity, one positive sign for producers was a pickup in new orders. The measure rebounded nearly 4 points to 49.3, indicating bookings are getting closer to stabilizing, suggesting they're really only slightly contracting. But what the article forgot to talk about was the backlog of orders, which I find interesting because here you see at 41.7, this is a serious contraction over May's print of 42.4. And for 21 months, we've seen backlogs contract, and now it's accelerating. And one of the key things to note here is that when backlogs are worked out, well, that means employees are not needed. And sales backlog is decreasing. This from some of the comments in the reports. We have furloughed a portion of our workforce as a result, and you can expect more of that coming. Elevated financing costs have dampened demand for residential investment. The level of production is lower due to decreased demand for products, and orders have increased only due to seasonal restocking, suggesting again across the board we're likely to see an increase in unemployment. And for President Biden, who has been bragging about how many jobs he's created under his presidency, this could be a dangerous game and may be the biggest reason he considers stepping aside. Because when we look at, of course, lending activity and the manufacturing sector, they go hand in hand. And here you can see the Philly Fed. This is a regional Fed survey. It's very similar to the ISM, but we don't have that official data in the St. Louis Fed database. And you can see that decelerations in credit are usually decelerations in credit are usually led by a deceleration in the manufacturing sector each and every time, while the Philly Fed shows a slight expansion. What we see from the ISM is, again, that continued slight contraction, suggesting things for U.S. manufacturers are going to get worse. And of course, that means that for the labor market, things are about to get a whole lot worse as we now look at continued unemployment claims against the Philly Fed current general activity index for the manufacturing sector. And you can see downturns in the manufacturing sector lead to rising unemployment claims, and the fact that people on unemployment, as we see here with continued claims, stay on unemployment. And this is a dangerous move for the economy and something that President Biden would not want to see. And if we start to see a further increase in continued claims, it would all but suggest that by November we're likely to be in a recession, and at that point all hope of him seeking a second term likely to be dashed. And here's the risk of all of it as Treasury yields now resume their climb, as Morgan Stanley flags former President Trump as a risk, as the market now starts to believe that he is the possible candidate for a second term. And this again is going to be dangerous for the economy because higher rates right now are not what we need. And right now the market believes that, and they're speculating on it, and we're only going to find out that it has absolutely nothing to do with who's in office. And across Wall Street, interest rate strategists are urging clients to start positioning for sticky inflation and higher long-term bond yields as a potential rises for another Trump presidency, because here's what's key. Presidents do not have control over consumer prices. When you go to the store and buy something, the president does not determine the price on that at all, nor do they determine interest rates. I think the markets will be digesting a Trump win, along with increased volatility in rates around a bias toward higher yield, as many people believe former President Trump, if elected for a second term, would lead to very high rates of inflation. But again, we come back to the manufacturing sector, and we note that that isn't the case, because where the manufacturing sector goes, again, that's where yields follow. And here we can see this is exactly what's happening in China. And the key point of why I wanted to start out the show when we got to the economic piece talking about China, because here you can see multiple cases where the Philly Fed manufacturing index goes, and underneath the green line is in contraction. Well, that means two-year treasuries shown in blue, they tend to head lower each and every time. But notably, go back to the 1980s. What happened? The manufacturing sector entered a contraction. The market and the Fed drove rates higher. What happened? Well, they ended up pulling back. We came out of the recession only briefly to find ourselves in a double dip recession. You look at the mistake we made in the 80s, you look at the mistake we're making now. There's a reason why. We talked about in a recent show, Herein said the Fed should have a July rate cut on the books. They need to bring rates down, but don't worry, they're not going to do it. We'll hear from Powell later this month, but odds are we're at the earliest we're going to see a September cut, and that is too little too late for the U.S. economy. And we've been in the camp that we should be thinking about a bear steepening. This means rates rising based on events that might not seem related but will come together. And the reason I wanted to show you the manufacturing sector is because you do not get rising rates except in the 1980s against declining manufacturing production. In fact, we're so linked to it that even if the Fed kept them elevated, the odds are rates are indeed going to come down. The notion that rates are going to rise into a decline in consumption is only going to further exacerbate the situation. And there's a sense that politics and this really populist evolution around the world is going to affect the amount of debt that we all need to absorb. But here's the issue. The more debt that's issued by governments, well, it means the more likely rates are coming down because they choke out the private sector. And if you can't create demand on the private sector, rates have to come down. This is something that not anyone, you can see these experts, they can't see it all. So the question remains is, will President Biden seek a second term? Well, we know his top officials are in meetings, and I imagine in the weeks to come we'll find out. But let's talk about black box stocks, because you want to talk about a tremendous opportunity to potentially earn a 20% return on your brokerage account. Check them out under the NASDAQ, under the symbol BLBX. Again, this is the fifth setup in the last 6 months, something I want you to be watching. If it pulls down these levels, you have to be considering a potential investment here. And here you can see black box stocks files Form S-4 for EV Tech acquisition. Let's take a look what's going on. Gus Kepler, the CEO, commented, "This is a significant reduction in our operating loss for the first quarter as the company looks to trim expenses, reflecting the stabilization of our membership over the past several quarters within the core business, as well as lowering operating expenses." And of course, they've acquired 13% of EV Tech Automotive, a sister company to EV Tech Aluminum, in Q2 of 2023, which we may seek to acquire following the acquisition of EV Tech Aluminum as part of a larger roll-up strategy, giving you the opportunity to get in early. The acquisition of EV Tech has taken longer than expected, but we're pleased to announce we have the S-4 filed and working to complete the transaction. And here you can see they're reporting the EV Tech revenue increased 115% in fiscal year 2023 and is projecting $52 million for fiscal year 2024. Suggesting that revenues and profits for Black Box are headed up, and that means stock likely as well. As revenue for the 12 months of fiscal year 2023 reached $30.9 million compared to $14.4 in the year before 2022. Revenue for the first half of fiscal 2024 was $21.3 million, an increase of 53%. The total projected revenue for this year, 2024, is expected to increase approximately $21 million to $52 million. And keep in mind, EV Tech proprietary ultralight aluminum plays a crucial role in the manufacture of lightweight parts for EV and hybrid vehicles. Nearly 2 million aluminum components are created by EV tech facilities every year for customers such as Jaguar Land Rover, Bentley, Aston Martin, Ford, Dunlop, and most recently even McLaren. And that sets up an opportunity in their stock. Let's look at that chart we looked at earlier in the show. And here you can see on the 6-month window, and you can see when price pulls back right around this $2.50 range. And what that means is this is where buyers come in and support the stock. And you can see every time it comes down here, it rallies out of that as buyers look to push the stock higher. A price rally up to $3 is about a 20% return. And you can see on average, that's the move it makes. Again, you can find them on the NASDAQ under the symbol BLBX. Now zoom into the 90-day window and you can see when it gets down here, buyers are eagerly snapping up the stock. You can see the volume profile at 281, where sellers recently drove it right down into the supply zone, but a break of that sends it right up into that $3-some range, indicating a potential 20% return for you. And as we look at the 30-day window, you can see very clearly where the volume profile line is right at that $3 mark. Again, an investment down here in the $2.50 range sets up a move, a 20% higher right into the volume profile, and a break there could send their stock even higher. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.